TCEHY, the giant behind WeChat, and a leader in online gaming and entertainment. Hello and welcome to Insight AI Brief Hang Seng. Today we're talking about TCEHY stock. Before we begin, please don't forget to like, share, and subscribe. Okay, let's unpack this immediately. We've got an incredible stack of source material today on Tencent Holdings. And look, this isn't just about their latest Q2 2025 results, right? It's really about decoding this massive and frankly expensive pivot they're making into artificial intelligence.
Exactly.
We have all the numbers, from these astonishing liquidity ratios, which we'll get into, to the crucial CapEx figures. So our mission here is to quickly pull out the knowledge nuggets you need to understand what Tencent's future actually looks like and maybe what risks they're taking to get there.
Yeah, and what's really fascinating here, I think, is trying to square Tencent's sort of dual identity. You know, on one hand, you've got the historical giant, this stable, cash-generating behemoth just relying on immense scale and those evergreen franchises like Honor of Kings.
Right, the cash cows.
The cash cows, exactly. But then, on the other hand, they are now acting almost like a startup, making these massive, long-term, really capital-intensive bets on foundational AI. And this AI pivot, which, you see it plain as day in the soaring capital expenditure.
Oh, yeah.
It's undeniably hitting their profitability margins right now, but it's arguably a necessary strategic cost, what promises that future AI-driven growth. So the core analysis for us today has got to be, can their incredible underlying financial health really truly sustain this huge, expensive tech commitment?
That's the big question. Okay, let's dive straight into part one then, the Q2 2025 performance and their core financial health. All right, let's get right into the financial engine room. Q2 2025 performance. The headline story here seems to be this robust double-digit growth. Looks like it's accelerating, actually. Total revenues came in at RMB 184.5 billion. That's a pretty healthy 15% year-over-year increase from Q2 2024.
Yeah, 15% is strong, and the quality of that revenue growth is really crucial. If you dig a bit deeper than just the top line, the gross profit showed even stronger performance. It was RMB 105.0 billion, which is up an impressive 22% year over year. And this pushed their gross margin up to 57%. It was 53% last year.
Right, so that margin expansion, that tells you something, doesn't it?
It really does. It strongly suggests significant efficiency gains, probably through better operational cost management, maybe even some early benefits from integrating AI into, say, content production processes, lowering the cost of goods sold, that kind of thing.
Okay, I want to circle back to something you mentioned earlier, which can be, a bit confusing if you're diving into these reports.
Yeah.
This distinction between IFRS and non-IFRS profitability metrics. Why does management always seem to stress the non-IFRS figures? What does it actually leave out?
Yeah, that's essential context. Management emphasizes non-IFRS because it's trying to give a picture of core operational health. It strips out items that might be, let's say, noisy or non-recurring or maybe non-cash.
Like what, specifically?
Well, think about things like amortization of intangible assets from, past acquisitions, or maybe one-time investment gains or losses. Share-based compensation is another big one. So stripping these out is supposed to give analysts a cleaner view of how the underlying businesses, the gaming, the advertising, the fintech, are actually performing day-to-day, quarter-to-quarter. It's meant to be the purest look at the engine itself.
Got it. So looking at those non-IFRS figures then, the core operational story looks, incredibly strong. Non-IFRS operating profit hit RMB 69.2 billion. That's an 18% jump year over year. And the operating margin correspondingly up to 38% from 36%. But you flagged a crucial nugget here that really clarifies the speed of this acceleration.
Yeah, this might be the most revealing data point in the whole report, actually. The non-IFRS net profit attributable to equity holders was RMB 63.1 billion. Okay, that's a 10% increase year over year.
Yeah, which is good. Right.
Which is good, but that 10% figure, it doesn't quite tell the whole story. If you exclude the share of profits or losses from associates and joint venture, those external investments they have,
right,
that core profit, the profit attributable just to their own operations, actually jumped by a much more impressive 20% year over year. It hit RMB 56.8 billion.
Hold on. So reported profit growth is 10%, but the core business growth is 20%. Does that mean Tencent is maybe letting slower joint venture results kind of mask the strength of their main divisions, or is that just how the accounting works out?
Well, it's largely standard financial reporting, how it works out. But the implication for you, as someone looking at the stock, is pretty clear. The core, wholly owned operations, think WeChat, the main gaming studios. The ad arm, they're accelerating at a really blistering pace. That 10% figure, while technically accurate, is a bit misleading because it gets dragged down by the volatility of their huge investment portfolio.
Yep.
That 20% growth rate, that's the figure that tells us the engine is running clean and fast, and that's what's fueling the war chest. This strong core performance also feeds into the basic earnings per share, the EPS, on an IFRS basis being RMB 6.115, another sign of that fundamental value creation.
That clarity helps a lot. And speaking of that war chest, let's look at capital deployment, because this feels like the data point that really defines their future strategy.
Yeah.
The capital expenditure, CapEx.
It is absolutely the most telling figure, and frankly, it's shocking. Capital expenditures surged by a massive 119% year over year. Yeah, to RMB 19.1 billion. This isn't just, a sign of minor expansion. This is a strategic signal. It signals a full-scale industrial transformation happening. That huge jump is almost certainly reflecting that heavy investment push into AI infrastructure. Buying up high-end GPUs, building new data centers, acquiring all the advanced computing resources they need to train their own foundational models like Hunyuan.
Okay, I have to ask though, 119% increase in spending on infrastructure. I mean, is that sustainable? How long can they keep doubling spending like that before those, historically superior operating margins start to look a bit shaky, especially if monetizing that AI capacity takes time?
That is the central strategic question, isn't it? But this is where the sheer scale of their cash generation provides the answer, at least for now. Despite that massive spending spree, look at the free cash flow. It stayed healthy at RMB 43.0 billion. That's still up 7% year over year.
Even with the huge CapEx spend.
Exactly. They are basically financing this doubled CapEx primarily out of their robust operational cash flow. They're not having to rely heavily on debt or external financing for it. And that ability to simultaneously invest so heavily in the future and maintain healthy cash flow, well, it speaks volumes about the amount of cash this business generates.
It's like a printing press.
Pretty much. And furthermore, look, they're still focused on shareholder returns through buybacks. They repurchased about 38.9 million shares for HKD 19.4 billion just during this quarter, so they seem confident they can fund the future while still rewarding current shareholders. Hashtag TechTag 1.2 deep dive into financial ratios and health.
All right, so we know the Q2 engine is running fast. Let's talk about the foundational health, the stuff that gives you long-term confidence. And we've got some interesting contrasting valuation data here that really highlights the recent shift in how the market sees them.
Yeah, it's quite a change. If you rewind to October 2023, the valuation story was really dominated by regulatory skepticism and worries about the macroeconomy. The trailing PE ratio back then was only 18.5. That was significantly below the industry average of 25.0.
Right, a big discount.
A big discount. And their price to book, the PB ratio, told a similar story. 4.2 versus the industry's 5.1. Basically, back then, Tencent was being priced almost like a value stock that had significant regulatory risk hanging over it.
And fast forward to today, October 3rd, 2025, that picture has fundamentally shifted. The TTM PE ratio now stands much, much higher at 28.18.
Yeah, that huge jump in the valuation multiple, that reflects a re-rating by the market, doesn't it? The market's now recognizing that double-digit growth acceleration and, importantly, the strategic value of this AI push. They're pricing Tencent more in line with other high-growth tech peers now. It seems like the market is betting pretty heavily on the success of that 119% CapEx investment paying off.
And just to give context on why the market might have been wary before, we should probably remember those big swings in net profit they had between 2020 and 2022.
Absolutely. It peaked, remember, at CNY 178.57 billion in 2021, but then it dropped sharply down to CNY 72.17 billion in 2022. That 2022 dip, that was a really brutal period for them. It was fueled by those regulatory crackdowns on gaming hours for minors, plus broader economic headwinds in China. That history definitely frames how you have to view the current regulatory risks. You can't just ignore it.
But even during those headwinds, the underlying quality of the business seemed high. You noted earlier they maintained superior margins compared to their peers, right?
Absolutely. Their gross profit margin, even in that tough 2022, was 45.7%, and the operating profit margin was 11.5%. Both of those were historically above the industry averages, which were around 39% and 10% respectively. What that tells you is they have powerful, persistent operational efficiency. Tencent just seems to have pricing power and cost controls that let it weather storms better than most of its competition.
Okay, let's talk liquidity now, the safety cushion. Their liquidity ratios are, frankly, extraordinary. Maybe we can just clarify what these ratios actually mean for the listener.
Sure. Think of it with a simple analogy. Imagine all of Tencent's bills that are due this year. The current ratio measures how many times they could pay those bills using only assets that they could reasonably turn into cash within the next 12 months.
Okay.
Tencent's current ratio is 6.5. Now, usually a ratio of 2.0 is considered pretty healthy, so 6.5 means they could theoretically pay this year's bills 6.5 times over.
Wow.
Yeah. And the quick ratio is even tougher because it excludes inventory stuff that might be harder to sell off quickly. Their quick ratio is 6.1. So this just shows they have ample liquid assets, cash, receivables, to cover pretty much all their short-term liabilities without even needing to sell a single piece of inventory.
That is just a staggering amount of short-term health. And I guess that sheer volume of capital they possess is what gives them the confidence for this big AI gamble.
Yeah.
The working capital number was around RMB 1,043 billion. And their cash reserves estimated at a substantial RMB 360 billion. I mean, that RMB 360 billion cash reserve, that's not just a safety net, is it? It's the actual war chest they're deploying for this enormous 119% capex bet on AI.
That's exactly right. And just to kind of finalize the stability picture, let's look at debt. Their debt-to-equity ratio is low, around 0.55. That's well below the Asia-Pacific tech industry average of about 0.75.
So quite conservative.
Very conservative financing approach. And combine that with strong credit ratings, A1 from Moody's, A+ from S&P, it just tells you Tencent is fundamentally rock solid. Now, you can argue maybe that conservative financing means they're leaving some cheap money on the table, relying just on internal cash when this AI race really demands maximum speed. But strategically, it definitely minimizes risk during what is inherently a pretty risky technological transition.
Makes sense. Okay, let's shift gears now into part 2, the business outlook, their strategy, and the growth and risk factors. Moving from the financial bedrock to the strategic direction, CEO Ma Huateng specifically said the company benefited from utilizing AI during Q2 2025. So this means AI isn't just theoretical anymore, it's a practical tool actually driving specific revenue segments now. Let's maybe unpack how AI is being applied across their huge ecosystem.
Yeah, this transformation is really happening right down at the product level. Take gaming. The application seems to be twofold: efficiency and experience. For efficiency, you've got AI tools that accelerate content production, think auto-generating textures, assets, maybe environmental details. That's potentially a massive cost saver, and it speeds up their release schedule.
Faster time to market.
Exactly. And then for the player experience, AI is introducing more realistic virtual teammates, more sophisticated non-player characters, NPCs. This kind of sophistication can keep users engaged longer, and it also helps boost user acquisition through more targeted AI-powered marketing campaigns.
And AI is also fundamentally enriching their social core, Weixin, right? Which is already massive. Weixin and WeChat combined hit 1.411 billion monthly active users as of June 2025. That's still growing, up 3% year over year. That enormous user base is the platform they're now layering these AI tools onto.
Absolutely. And the AI features here seem designed to enhance that whole commerce and communication loop within Weixin. For instance, they now provide intelligent responses for merchants using mini shops. That improves customer service efficiency, hopefully boosts transaction volumes within that whole mini program's ecosystem.
Makes sense.
And then for the average user, AI is providing things like content citations and, crucially, especially for the video age, automated text summaries for video clips posted on their massive video accounts platform. It just makes consuming content faster, more accessible, and ultimately stickier, keeps people on the platform longer.
Okay, and the third major area seeing immediate, maybe high margin benefit is advertising, or as they're calling it now, marketing services. That name change itself seems significant for Q2 2025.
It really does. I think the name change signals a shift away from just traditional advertising towards being a technology-driven optimization engine for marketers. They explicitly said they upgraded their advertising foundation model, and that directly translated into measurable improvements in click-through rates and conversion metrics.
So advertisers are seeing better results.
Exactly. And when advertisers see better returns on their spend, demand skyrockets, and that's what they reported. Robust advertiser demand across video accounts, mini programs, and weeks in search. This is probably the simplest, most high-margin way for them to monetize that AI investment almost immediately.
Okay, beyond the applications, we have to talk about their foundational AI commitment, the really long game. Their Hunyuan foundation models. This is Tencent's entry into the deep AI race, right? Competing head-to-head with global leaders. What are the key tech breakthroughs they're highlighting?
Well, the technical sophistication seems pretty evident. For content creators, for example, their Hunyuan 3D model ranked first on the Hugging Face 3D Gen leaderboard for geometric precision and texture fidelity.
Okay, what does that mean in plain English?
It basically means their models are objectively top-tier, world-class for generating realistic digital content. That's a massive potential advantage for their gaming and maybe future metaverse ambitions. But perhaps more critically for their profitability, they launched this Hunyuan Turbo service. And that uses something called the mixture of experts, or MOE architecture.
Right, MOE architecture. We hear that term a lot now. But for the listener, what does it practically mean, and why does it matter so much, especially if they're trying to offset that huge CapEx spend?
Okay, so the MOE architecture, it's potentially a game changer for these huge language models, because instead of activating the entire massive model for every single request, which is computationally very expensive,
Right.
it only activates a specific set of experts within the model, the ones that are most relevant to the query you just made. Practically speaking, this drastically reduces the computational power needed during both training the model and running it for users, what's called inference. And Tencent claims this architecture is doubling their model training efficiency and reducing the processing cost by 50%. Now, in this hyper-competitive, super capital-intensive AI race, cutting your processing costs in half, that provides a monumental structural cost advantage. It really helps justify that massive 119% CapEx investment over the long run.
That makes a lot of sense. And their commitment to R&D was huge even before this recent CapEx spike, wasn't it? Back in 2022, they allocated something like RMB 43.8 billion, what was that, $6.8 billion US toward R&D?
Yeah, a huge number.
And they also committed a massive $1 billion over 5 years back in 2023 through some strategic partnership with a leading AI firm. So this isn't just a fleeting trend for Tencent, is it? It feels like the core strategic priority for the next decade.
It absolutely seems that way.
Okay, let's refine our understanding now of where the actual cash is coming from to fuel all this. Value-added services, VAS, is still the biggest piece of the pie, right? Made up 50% of total revenue in Q2 2025. Grew 16% year over year to RMB 91.4 billion.
That's right, still the giant. And within VAS, of course, gaming is the heart. And the numbers here show a really fascinating split. You've got domestic stability, but international acceleration. Domestic games revenues were RMB 40.4 billion, up a solid 17% year over year.
Which is strong.
It is strong, and that was buoyed by new releases like Delta Force. Apparently, that exceeded 20 million monthly average daily users, DAU. So it quickly established itself as a major internal hit for them. And of course, the evergreen games, Honor of Kings, Peacekeeper Elite, they just kept maintaining their remarkable resilience.
But the real acceleration story in Q2, it sounds like, was international games.
Absolutely. That surged 35% year over year to RMB 18.8 billion. And this is such a crucial diversification move for them, getting more revenue outside of China. This growth was fueled by classics like PUBG Mobile, sure, but also the stellar performance of Supercell games, which are inherently very international.
Right, Clash Royale and those.
Exactly. Specifically, Clash Royale apparently saw a significant boost in monthly gross receipts, hit a 7-year high back in June 2025. And that was due to strategic content updates, community events. It really highlights that synergy of using existing IP but constantly refreshing it with new content. It's a strategy they seem to be adopting for new releases too, like Dune, Awakening.
Interesting. And you also noted that mini games, the ones sitting within the Wixen ecosystem, they're also seeing accelerated growth. Gross receipts up 20% year over year.
Yeah, which confirms that the underlying tech infrastructure investment, maybe some of that AI stuff, is helping even those smaller embedded revenue drivers perform better.
Okay, so beyond the dominant VAS segment, we see that necessary diversification. Marketing services revenue rose 20% year over year to RMB 35.8 billion. And as we discussed, that strong growth rate seems directly linked to those AI-driven improvements, making ads on Weixen just much more effective.
Yep, better returns for advertisers equals more ad spend. Simple as that.
And finally, fintech and business services rose 10% YoY to RMB 55.5 billion. Now, this segment seems driven partly by traditional financial services. Commercial payment volume growth, consumer loans, wealth management. But the really interesting bit here is that this segment's growth actually accelerated compared to prior quarters. And the reason given was increased enterprise customer demand for AI-related services.
This is critical, I think. This acceleration in business services confirms that the expensive AI infrastructure they're building isn't just an internal cost center, it's already being monetized externally.
So other companies are paying them to use it.
Exactly. Enterprise customers are paying Tencent for things like GPU rental, for API token usage for their own internal AI development. So that 119% CapEx, it isn't just an internal cost, it's actually becoming an external revenue-generating service line, which adds a pretty fascinating layer of justification to that huge investment, doesn't it?
It really does. It's not just cost, it's potential future revenue stream in itself. Okay. Hashtag 2.3 key risks and growth constraints. Now, a company this large, operating where it does, it inherently faces massive risks, and we can't have a proper deep dive without really exploring those constraints. Regulatory scrutiny. It seems like the big recurring threat, doesn't it?
Absolutely. It's the elephant in the room, always. And the historical impact is just indelible. Remember the 2021 gaming regulation, the one limiting minors to 3 hours of gaming per week? That resulted in an immediate and pretty painful 9% decline in their gaming revenue back in Q4 2021.
Yeah, I remember that. Huge impact.
Huge. So that historical precedent just means investors have to remain vigilant. Current regulatory risks could include potential changes around the acquisition of advanced chips that would directly hit their AI development pipeline, or maybe new advertising regulations. Tencent's mitigation strategy, of course, involves continuously enhancing its compliance teams, its lobbying efforts, but this risk is just inherent in operating in the Chinese tech market. You can't wish it away.
And then there's the broader macro environment to think about, too. China's economic slowdown GDP growth was only around 3% back in 2022. That creates a challenging consumer environment, right? It affects advertising spending, commercial payment volumes. It's just a constant kind of headwind to growth.
Yeah, definitely a factor. And we also have to account for just intense competition. Tencent faces major rivals across literally all its segments: gaming, social media, cloud, and now especially AI. You've got giants like ByteDance with Douyin, TikTok, and Alibaba. This AI development race is just hyper-competitive. It requires continuous, massive investment, which puts relentless pressure back on those margins we talked about. And furthermore, there's that persistent strategic risk from their massive investment portfolio. Remember back in 2022, they reported a significant impairment loss, about RMB 28 billion, related to investments that performed poorly. It's just a reminder that their diversification into venture capital type investments is definitely a high-risk, high-reward kind of proposition. Some pay off big, some don't.
Right, adds volatility. But despite all these constraints, the forward-looking estimates from analysts still seem pretty bullish. They're projecting total revenue to reach RMB 620 billion for 2024. That's about 12% YoY growth, and then hit RMB 700 billion by 2025, another 13% YoY growth.
Yeah, that optimism seems based on several strong factors. One, the continued success of those evergreen franchises. Two, the aggressive international expansion, particularly in mobile gaming, which itself is projected to grow globally at about a 12% compound annual growth rate through 2028.
Okay.
And then, most importantly, I think the expected monetization trajectory of the AI platform, both internally driving efficiencies and externally selling API usage and GPU time. Plus, you have to factor in the company's massive financial discipline and that low debt position. It just ensures they have the stability to navigate temporary economic turbulence better than most.
Okay, that sets the stage well. Let's move into part 3, analyst and technical views. All right, let's try and contextualize the stock's recent trajectory. It's been quite volatile before this latest surge, hasn't it? The price moved significantly in the run-up to 2023, peaked somewhere near $75, but then settled back around $65 by October 2023. This recent momentum is really why that valuation picture we discussed has changed so dramatically.
Yeah, the current price really reflects the strength of that Q2 report and all this AI optimism. The stock price as of October 3rd, 2025 was $86.56. That leap is basically the tangible result of that sharply rising PE ratio we analyzed earlier. It seems like the market is rewarding the strategy, at least for now.
So, turning to the analyst consensus, what are they saying? The overall average rating seems to be a moderate buy.
Yeah, kind of cautiously optimistic, maybe.
Yeah. The average target price is around $90 per share, which, okay, suggests maybe some moderate potential upside from that recent $86.56 closing price. Goldman Sachs, for example, they're pretty bullish. They have a buy recommendation, recently raised their target for the Hong Kong listing to HKD 595. And they're citing, strong fundamentals, that acceleration in international gaming, and the clear AI momentum as the key drivers.
Right. But the view isn't monolithic, is it? We should probably acknowledge the contrasting, more cautious views from firms like, say, Strata Advisors. They seem to question the sustainability of the recent growth, worrying about over-reliance on existing intellectual property, existing game franchises, and pointing to that ongoing macro weakness in the Chinese consumer market.
So their concern isn't necessarily about the AI potential itself.
No, it seems more about execution risk. Specifically, can Tencent innovate enough new large-scale game franchises to really support this higher multiple? Or are they just kind of milking these aging, albeit very resilient, hits?
That's a really key debate, isn't it? The market seems clearly divided between those who are valuing the long-term AI future, which promises total new growth avenues, and those who are still wary about, market saturation and potential regulatory interference in the core existing business. Hashtag 3.2 dividend analysis.
Okay, so given that Tencent is this mature giant, but it's undergoing this rapid AI transformation, what does its dividend policy look like? Is it rewarding shareholders now?
Well, the dividend policy definitely reflects that growth mandate we've been talking about. For the ADR, which is TCEHY, the dividend yield is actually pretty low. It's only 0.58%. So look, this isn't really a stock you'd buy primarily for income today.
Right, and that low yield is directly tied to the low payout ratio, isn't it? It's only 22.24%.
Exactly, and that, I think, is the critical piece of the puzzle here. A low payout ratio like that confirms their strategic choice, retains significant capital, nearly 78% of their earnings, for aggressive reinvestment back into growth. It reinforces the whole justification for that 119% surge in CapEx, right?
Yeah.
They're funding the future internally, prioritizing capital retention over just immediate shareholder distribution.
But that being said, the commitment to increasing that payout over time looks remarkable. The 5-year dividend growth rate is extremely strong, plus 31.57%.
That's huge growth.
It is. It feels like management is telegraphing confidence, doesn't it? Confidence that the heavy investment they're making today will yield much higher sustainable free cash flow down the road, allowing them to rapidly increase that dividend in the future.
Yeah, it's a promise of future returns based on current investment.
Exactly. And the dividends are paid annually. The annualized payout is currently $0.50. The next ex-dividend date listed is May 19th, 2025. So that just cements that annual payment structure and reminds us that, while the yield is low now, the growth trajectory for that dividend has been very high. Hashtag 3.3 technical analysis and chart trends.
Okay, finally, let's look quickly at the technical signals, just derived purely from the latest price data as of October 3rd, 2025. The stock closed at $86.510.
Right. And when you place that closing price within its 52-week range, the picture is definitely one of strong momentum. The low for the year was way down at $46.76. The high was $87.12. So that closing price of $86.51, it's essentially knocking right on the door of the 52-week high, only out 61 cents away.
And that proximity to the high, that's a critical technical signal, isn't it? What does it usually suggest?
Well, typically it suggests strong recent momentum, strong investor confidence. It implies the market is really pricing in that positive surprise from the Q2 results and the perceived success, so far, of the AI strategy. It indicates that the recent bullish sentiment hasn't really met any major psychological resistance level yet.
Okay.
And furthermore, the daily movement showed stability right near that peak. It traded in a pretty tight range between $86.300 and $86.800. Now, for a stock of this size to be hovering right near its annual high like that, it generally signals that the broader market sentiment is strongly bullish. Driven by this narrative that, Tencent successfully weathered the macro and regulatory storm, and now it's capitalizing big time on AI. A successful break above that $87.12 resistance level would technically confirm a breakout to new territory. That would suggest the AI strategy has really fully captured investor imagination.
Interesting. Okay, let's wrap this up then. Hashtag tag outro. So to try and summarize the crucial takeaways for you from this deep dive, Tencent's Q2 2025 performance, it showed accelerated high-quality growth, especially when you factor in that 20% underlying core profit surge, kind of stripping out the investment noise. This core strength seems to be providing the foundation for their really aggressive strategic pivot towards AI. And that pivot is undeniable. Just look at that staggering 119% increase in capital expenditure, clearly focused on AI.
Right.
Now, while the valuation has risen sharply, that PE is up at 28.18, the company's fundamental stability, which is anchored by that extraordinary liquidity, the current ratio of 6.5, and that massive RMB 360 billion cash reserve, well, that provides a huge financial buffer for this expensive transformation.
Yeah, absolutely. And this leads us right back to that final kind of unavoidable conflict for you to consider as you think about this stock. Tencent's robust liquidity, as you said, suggests it can easily withstand this massive strategic investment. But given that profitability dipped so severely back in 2022, partly due to those external factors, is the current double-digit profit growth truly sustainable? Or will the continued high cost of this AI race, which seems to require them to basically double spending on CapEx maybe year after year for a while, will that eventually erode the long-term margins that historically outperform the industry? That feels like the core trade-off that defines Tencent's investment profile today.
A great point to end on. Finally, if you have any other stocks you'd like us to cover, please let us know. Don't forget to like, share, and subscribe to support our team. Thank you.